Okay, thank you very much for joining us for our panel this afternoon and for taking the time to come and spare this 1 hour and 15 minutes with us to talk and think about in one of the very important topics in my mind that I personally now work on since more than 10 years, to find new ways of finance innovation for scalable global technology deployment. My name is Chris Häuselmann. I'm a co-founder and chairman of the Global Cleantech Cluster Association, which I'll introduce very briefly afterwards. And I'm very excited to have a fantastic panel here with us. It's a very unique panel, and you will see why it's so unique and why I'm so excited to have you all here when you hear who those people are. Oops. So maybe if Samy, you can introduce yourself, 30 seconds each, very briefly from where we are and what you're working on in very short words.
Okay, hi, I'm Samy Ben-Jaafar. I run the private sector investment arm of the Green Climate Fund. We're a $10 billion fund whose contributions come from G20 countries with a mandate to do infrastructure in developing countries. Clean infrastructure.
Markus? All right. Hello, everyone. My name is Markus Lampinen, and I am the CEO of a company called Crowd Valley. We are a technology company, and we have created a product, what we call a digital back office, that specializes in bringing existing lending or investing models into an online application. So we work with applications such as or in the realm of fintech, financial technology, such as peer-to-peer lending, online wealth management, solar bonds, so on and so forth.
Thank you. And David?
Thanks. My name is David Berliner. I'm the CEO and one of the co-founders at CoPower, where we make it more simple for Canadians to invest in clean energy. And we do that by running an online lending and investing platform.
Thank you. And then Roger Wagner?
I'm Roger Wagner. I'm a senior counsel with Dentons and also a managing director of P80 Group, which, as you'll hear more about, is an organization founded back in 2012, following up on Prince Charles' convening of the P8 Group in 2011 to mobilize pension fund investment in Cleantech.
Thank you. And Li Qi?
Yes, hi. My name is Li Qi. I'm a research fellow in Zhonghua Institution for Economic Research, and I'm also the deputy director for Green Trade Project Office in Taiwan under Ministry of Economic Affairs. So GTPO is major platform for green business in Taiwan and also one of the cluster members in GCCA, and we have provide on-site green consultations to more than 150 major companies in Taiwan, and also provide training to more than 5,000 people since the year of 2011. So I hope here to make more collaboration and partnership in Vancouver. Thank you.
Thank you. And when you now see, who is on the panel, for me personally, this is a kind of a historic moment, actually. When you think about, you have some representatives of the largest pension funds in the world that really have to invest trillions and have to invest hundreds of millions of dollars, with a 20-year horizon that creates the return that when we then get retired, we actually have money back for our retirement. On the other hand, you have this is the top-down investment. The other one, you have the bottom-up investment, where you have, with Markus and David Berliner, two people that work on how can we bundle 100,000 people that pay $10 each to make a $1 million project work. So we have two ends of very interesting and very important organizations here on one panel. And to my knowledge, I never experienced this before, so thank you so much that you're here and making this happen. This is a very important moment for us all and for me personally. Maybe very briefly to what GCCA is. I'm originally from Switzerland, and Switzerland is a small market. We have 8 million people, so our generations, we're used to do international collaboration because our home market is just very small. And when I launched Swiss Cleantech as a business association in Switzerland, I learned then that also other regions have cluster organizations, but no one knew each other. And then together with Finland, we launched the GCCA in 2010 to bring together these clusters. On one hand, that we can learn from each other as cluster managers, as kind of a peer-to-peer coaching. On the other hand, that we can drive business for the cluster member companies. In 3 years, we grew to 50 clusters around the world in 27 countries, representing around 10,000 companies, because each of those clusters on average has 200 to 300 member companies. These companies are startups, but also SMEs and also large corporations, multinationals. So we have a very unique set of companies, and we decided to launch an award in 2011, which now is an annual GCCA later stage award. These are later stage companies that are not looking for $50,000 or $100,000, but for 5, 20, 50 million to really go to new markets to double their production sites. So it's later stage companies. Every year we can get from the cluster these nominations. We have now analyzed more than 600 companies all overall. We then choose the top 30 winners, finalists, with a Keystone Compact assessment tool that we developed with the University of Michigan. And from these top 30 finalists, we then choose the top 10 winners every year. So this allows us now, we have around 600 companies that are assessed. We have 150 top 30 finalists and 50 top 10 winners. I'm very excited to announce that the later stage award this year is launched actually here today at the Globe. And we will then present the winners at the event in Little Rock, Arkansas, that we'll invite you in the very end, Arkansas, December 11 to 14th this year. Why is this important? These clusters give us the knowledge and the know-how how to think about this new finance mechanism. When I started to work with the P80 group, we signed a collaboration agreement in 2013 together with Roger Wagner. We learned about what the restraints are from the pension funds. So we learned that, for example, large pension funds, one of their investments, the smallest investment, is about $500 million US. No company can absorb so much money. So the basic idea was, how can we bundle 100 companies that need 5 million to come up to this 500 million? This was the very basic concept. This then led us to reach out to Markus Lampinen from Crowd Valley, because we thought if he knows how to bundle 10 or 100,000 of people, this mechanism of bundling, we can learn from each other. And this led to a very deep business and also friendship, and we signed a collaboration agreement last month, actually also with Crowd Valley. So we have now with GCC a collaboration agreement with the P80 group, the pension funds that are the top-down money, and with the Crowd Valley that comes from the crowd investing, crowd equity, and peer-to-peer lending. This is our base of knowledge. And what we designed is what is called a multi-asset renewal fund, MARF, where we designed this idea of how to bundle these 100 companies. We were very fortunate that the Finnish government understood our idea and gave us in December 2013 a project where we can now realize this idea with real Finnish companies and real Finnish pension funds. We made such tremendous progress that now we were able to launch the same MARF program in January in Switzerland, and we will hopefully also then have negotiations or discussions with the BC region to do something similar here. This is to give you the big picture. But now I would like to turn to our tremendous panelists, and I would like to start with you, Samy. You are in one of the largest funds, the Green Climate Fund, and I would like you to ask a personal question, like when we are in the discussions with the pension funds, somehow I wonder if they really want to work with us, if they really are interested in this transformation to invest in low-carbon technologies, or if this is just more a marketing thing, they have to say they want to do it. So, is this real or is it not real? A very personal question.
Look, I think in any relationship there has to be mutual benefit and long-term mutual benefit. So we know what our needs are in the climate space, and we've been raising our hands and saying, hey, we need your money. The question is, have we taken the time to understand what their needs are? And they said, we're interested, but we need to understand what their needs are. Ultimately, they have a mandate, and their mandate is to manage the money of school teachers, nurses, the average Joe, and see it through safe waters for 30 years so that at the end of the 30 years you get a safe retirement. So then the question becomes, if that's their primary mandate, and they're regulated to do so, if that's their primary mandate, how does our proposition fit into that mandate? Not so much how do we get them to take a deviation around that mandate. Because if today you ask any one of us, hey, listen, there's new clean tech in Zimbabwe, it'll save 100 lives, everyone will say yes. But if you say, look, you have to put your pension at risk, and at 65, I don't know if I'll be able to pay out what I promised you, you'd think about it twice. So then the question is, how do we address systematically their risk issues? Bundling is important in that it provides them with risk diversification. And there's a lot of talk about taking out the credit risk, but pension funds have to manage something that's as big as credit risk, and that's liquidity risk. And while the rest of us have forgotten about it because the market's flushed with cash, pension funds realize, especially with the demographics of this current generation, that liquidity is going to be a big issue when it comes out to pay out over the next 30 years. So bundling liquid assets, and they'll come in. Until we find a way of doing that, they're going to sit on the sidelines. And it's not because they just want to pay lip service. They're saying we genuinely want to put our stakeholders' monies into that, so give us something that we can put the money into.
Thank you. And maybe I want to ask you, Roger, with the P80 group that was actually founded by Prince Charles in 2007, because he thought, where is the most money? It's at pension funds. And why is this money not flowing to sustainable investment? He put together a group of the largest 8 pension funds, P8, which then grew over time to the P80. And Roger, in your following and working with the P80 group as a managing director, how do you see what changed in the last maybe 1 to 2 years? And do you think if the low interest rate or the quantitative easing with the money printing is also changing the view of the pension fund managers and the boards of pension funds?
Well, I think that the task of finding mechanisms for pension funds to invest more into renewable energy, clean tech, has always been difficult for the reasons that Samy just alluded to. Lack of diversification. If they manage to fill the frame of an infrastructure project, and they have a long-term power purchase agreement, it's a wind project, and it's supported by various credit guarantees and conventional project financing, then more and more pension funds have turned to infrastructure as a stable, long-term investment with relatively low risk and low potential for substitution, which is another way of saying low competition. They're not going to be displaced and made obsolete, and so they're a safer investment. I think when you get into the area of technology, where many people want to think about sustainability, you have a much tougher time, because if the technology is not as well established or requires development or has a risk associated with it, it's not going to fit the model of low risk that the pension funds are seeking. Now, having said that, there are some recent examples. The White House convened a clean tech initiative in June that was a follow-up, and as a follow-up to that, I should say, a new vehicle was promoted that is being fronted by the former head of the DOE's loan guarantee program, and in which they've gotten several different pension funds to put their money in as a way to promote newer technologies. It's restricted to new technologies. So I think the issue is to try and have a small pot of money at least being liberalized from the pension funds based on the highest level government support and, if necessary, amendment to the pension fund rules.
Thank you. So the risk or perceived risk is a very important element, for the pension funds. And now I want to turn to the very other end, with you, David Burnley. You just launched CoPower in Toronto. And how do you see the reaction of the people actually joining your platform and starting investing through your platform? How do you see, how did this develop in the recent months?
Yeah. So the reaction's been great, but I think it also speaks to the bigger question of, you're talking about the top down and the bottom up. And so to be clear, the goal is to mobilize the $10 trillion that the WEF and the IEA says we need to invest over the next 10 years in green infrastructure, and that money is coming from pension funds and sovereign wealth funds. Full stop. So the question then becomes understanding, like Samy was talking about, how do those infrastructure teams invest in large projects that are sufficiently de-risked and are well understood? And then the question becomes, okay, we understand how the pension fund invests $500 million in a solar farm. How do we help get the next types of technologies to that same scale? Because the pension funds are investing in solar and in wind. Those are great yielding assets that meet their annuity needs. But we've got a ton of other technologies that are brewing in geothermal, in combined heat and power, in making buildings more efficient. How do we help take them from where they are right now into the $100 million and $500 and $1 trillion scale? And that's where we think there's a really interesting gap in the market, and where matching via an online technology-enabled platform, matching everyday investors who are very happy to make 5, 6, 7% returns with these assets. The reason the pension funds don't invest in a $10 million deal is because it's too hard for them. Their teams need to put out huge amounts of money, and their transaction costs to do that are enormous. So it's really understanding what is the challenge of he or she that's sitting at the pension fund's infrastructure team, and how do you feed stuff into him or her? And so we think that that servicing this market that's in the smaller 1 million to 10 million to 50 million size, by enabling more people to be putting their RSP money and their savings into these infrastructure deals, is a great match. There's a separate conversation to have about technology, newer technology, VC, the Prime Minister talking about mission innovation, that he and joined Bill Gates and other leaders to put more R&D money to play. But that's over here on the ecosystem. So I don't necessarily think the pension funds are the ones responsible to be bringing that new technology to play. It's understanding what the right fit is for each group.
Yeah, I like that a lot, and this is actually what we learned over the years. This is the crucial element, that we have this dialogue and understand where each other party sits. And I think, Markus, you're in a very interesting position because you kind of create the back office technology that allows not only the individuals to invest smaller amounts of money, but also allows the large partners, finance partners that you have, to get into the digital finance world. So in this way, you're kind of one of the pioneers in bringing fintech and also cleantech together. And that's what I'm so excited about, and maybe you can share your perspective, being kind of this middleman between the different parties.
Sure. So the way that you can think about our position as a company is that we're very much in the back office. So we have a product upon which these models can be created. So that means that today we see over 100 different marketplaces with various different transactions. And just echoing the points raised earlier, I think it's really important to recognize, I run a Silicon Valley tech company, so my perspective is obviously very much from that kind of that role. But that being said, it's really important to recognize the situation that we're in, the different stakeholders, their different needs and requirements. I don't really believe in a replace-all type of solution as it comes to fintech. It's rather about how finance technology fits into existing lenders, existing asset managers, existing institutions, and how they can leverage it for maybe increasing their efficiency. And talking about that point about pension funds not being able to operationally take on smaller deals, then one of the problems that we oftentimes find ourselves working with is that bringing down the cost of doing a particular deal then that means that essentially, instead of dealing with maybe 50 institutions, you could deal with 60, maybe 70, maybe 100. So the point is, for a pension fund, for example, that if your cost for closing a deal is X, regardless of the deal size, then would you not rather do $500 million deals rather than $50 million deals if the cost doesn't change? And we're in the business of changing that cost. That a lot of our clients, they look at essentially how they can add structure, transparency, and efficiency into how they structure deals, how they communicate with these different stakeholders, how they manage the entire, call it the workflow, from origination to the actual closing to the investor communication, the updating, and what have you. Obviously, this is regulated activity, so we work with a lot of different institutions that are experts in the process that they've got. But just thinking about the different stakeholders that are at play as it comes to clean tech and green innovation, then it's really important to think about how they could better interact with one another, how they could better leverage essentially today's tools, not tools of the 90s, but today, in terms of actually being able to close these deals more efficiently, source the deals more efficiently, manage the deals not just through to the investment, but through their life cycle. Because a lot of the technologies that we're talking about today, they're not quick technologies. They're not things that you get immediate revolutionary gains from. They have pilots, they have iterations, and they have a really long life cycle, hopefully, in generating benefits. But I think one of the overarching points that we see is that when we talk about fintech, especially from the Silicon Valley point of view, then it's really easy to get carried away and think 10 years into the future, 20 years into the future. And that all is very important. That's an important conversation. But thinking about the very practical benefits of today, those are often quite mundane. And increasing efficiency at different points in that and between the different stakeholders, that's probably the quickest way that you get the stakeholders in the same room, so to speak.
Well, I always like, in the discussions with you, the very practical approach, and we actually work now with some selected companies, one of which is actually here with Lars Willi from WeConnect, that we work through how can now a company, work through a crowd investing platform. How do you do that? Which platform do you choose out of the 100 that you have? That now every day, if I'm correct, $5 to $6 billion are transferred every day. This company was founded 5 years ago. You see what can be done. So we work on very practical cases, and as soon as we have some results, we'll then also share that with all of you. But I would like to ask Li Qi, as a cluster manager, representing around 200 member companies, you're in daily discussions, how they can get funded, how can they finance their growth, and maybe your first spontaneous thoughts, hearing now from the top down and the bottom up finance mechanisms, what could that mean for you as a cluster and for your member companies?
Yes, thank you, Chris. I think according to our observations from our member companies in GTPO, and right now they are still at the stage of looking for money because in Taiwan, we have more innovations on technologies. We have a very successful case in technology innovations, but still lack of those financial or business models because market condition in Taiwan right now still don't fit very well because some of the investors, they think that the market for green is not promising at this moment. They think that, especially in Taiwan, the price of electricity is quite low. So some of the environmental industry, like ESCO, still cannot go into the market so easily. So I think the basic logic I am trying to point out is that in our case, we do think the government regulation play a very important role because we have one case, it's a PV producer, and their efficiency is not quite good compared to the other competitors. But after the government launched the policy of a feed-in tariff, they successfully grow up the market, become the biggest producer in our market by utilizing the financial model. So I believe the financial model are really needed. But still, I think the government policy will play a much more important role in our market right now.
Okay, I see. So thank you so much for the first round, and I would like to turn now actually to our panel commentator, John Watkins from Kensington Capital in Toronto. You're very experienced also in large project finance. And I would like to ask you, like, what are your first spontaneous thoughts when you now hear what we have learned from these two ends, the top down and the bottom up? Sure. Mm-hmm.
Everybody hear me? Oh, great. Yeah, I'm with Kensington Capital. We're a Toronto-based asset manager. We manage about 950 million as of today. I'm pleased to announce that we just closed a $306 million venture capital fund with our partners in the Government of Canada today. So we're investing in Cleantech. 1/3 of it will be in Cleantech, and 1/3 of it will be in Western Canada. But what I heard from the panel is, it's tough at both ends, but there's also a middle ground. And one of the things that Kensington has discovered a long time ago, it's really tough raising money at the bottom end, and it's also very tough at the top end. The pension funds, they like to deal with other billion-dollar sized ventures and companies. CPPIB, it's G&A, its administration for the year is $1 billion. They've been in business 13 years. We can't compete with that. They won't even look at a project that we bring forward. So what we've done is we've taken institutional products and brought them down to individual accredited investors, high net worth, or family offices. And we're having a great deal of success at doing that. And those people are willing to take risks. They're tired of investing in stocks and bonds with a stock market that's going all over hell's half acre. And they want to put their money into something that gives them stable, predictable cash flow. And not all private equity or venture is in that space, but infrastructure funds are. So we try to mix and match it. So I think what I heard is that, not only is there the top end and the bottom end, there's a middle. And there's a lot of people in that middle, and more people every day who've got money. The growth of family offices in Canada in the past 20 years is enormous. There's a lot of wealth out there that's looking for something different. And it's a matter of tapping into them the best way we can. So that's my initial comment.
Very good. I like that. And maybe, what we see also in what you're very correct, that we have to work with all the players. We with GCCA, we work a lot with the pension funds because we believe, the transition into low carbon economy and society, we need to have a model that works for the largest institutional investors. If we don't have that model, we will not be able to allocate the money or to raise and allocate the money that is required for this transition. But we fully agree, and we partner with a lot of the middle partners as well. But just our focus on finance innovation is really on the large guys. And we know, the large gorillas like to play with the large gorillas. We're not the large gorillas, but actually through the work that we did, we learned that they really appreciate that we help them to understand and find a new finance mechanism.
But the growth, Christian, is, there's a whole bunch of, the innovation happens at the smaller ends of the spectrum. The small projects are where there's a lot of innovation going on in energy storage, geothermal. You don't get, $1 billion, there's only $1 billion geothermal company in the world. But the innovation's happening at the $100 million, $50 million market cap companies. That's where it's happening.
Exactly. And
so how do you match the pension funds who have this enormous need to invest in billion-dollar projects that are in decline? There's not that many mega projects in the world every year. Exactly. And there's 10 bidders.
Exactly. This is exactly
No, I'd like to talk about a couple of models. Another model that has been brought forward is where some of the large fund groups like TPG, in this case, has a fund called TPG ART, Alternative Renewable Technologies Fund. And the fact that they have so much money under management, it includes, of course, pension fund money. So in effect, what they're doing is they're taking a portion of that fund base and dedicating it to a fund. So it's even more indirect, but they are getting down to the level of individual companies. Now, they're not the earliest stage companies, but they're with proven technologies. One of the things that the founder of Sun Edison said was recently was, you know, we don't need to invest. He took issue with Bill Gates' view that they need a breakthrough energy coalition to take entirely new technologies in order to solve the energy problems, get a Manhattan Project mentality, bring the government in, etc. He took issue with that. He said, we have the technologies pretty much that we need. We just have to scale them. So there's real opportunity, I think, for this new participants, new forms of participation to work that way. And I think that's happening in the Norwegian fund. They've found a way to do this as well. And so I think we're going to see more and more of that. We're not going to see a lot of direct investment by pension funds. They're going to be going through a fund of funds or two levels of funds in some cases.
Exactly. No.
But let me just make one more comment. But the fact of the matter is, it becomes, and we've been talking about this in this conference, it becomes imprudent almost for pension fund board members not to be seeking out such mechanisms given what's coming, the train that's coming at them in the form of a new economy and a new carbon environment. I mean, it's if they're going to be safeguarding their assets and their pension fund holders, they have to find ways to meet this challenge and do something with all that money that's being disinvested.
David?
Well, yeah, and I think it's instructive to look at how solar went from 2005, $0 billion a year industry to today over $100 billion a year. And it's because the people who were early at Sun Edison and others went and got the first 50 million of project finance capital from Goldman Sachs. And that led to a spiraling effect where you demonstrated a business model, you demonstrated you could build infrastructure assets, and you demonstrated you could build them homogeneously and at scale. So now pension funds in Ontario and others are deploying billions of dollars into solar energy. So solar's there. It's how do we take, we're talking about the next breed of technologies that are coming through from early stage VC that are growing and going through the Cleantech clusters. How do we help them get their next 50 million, 10, 50 million deployed? So then they have a track record when they go into the pension fund groups and say, we've checked all your boxes already. You have a mandate from your boards to invest in green. We've already hit all your boxes that you need to hit. Now we're working on a synergistic relationship.
Yeah, I think deployment versus development is an important distinction. Pension funds are not going to be involved. I mean, despite this recent example with the Obama initiative and this intermediary that they've set up to do essentially new technology investments, that's not their main focus. It's going to be on developed technologies that they can say are completely commercially reliable and demonstrated. So then what I think we're looking at is the deployment of business models almost. So we're talking about Solar City earlier having some sort of an edict from the management or the board. We want to go to 2 new countries a year. And that's going to take their very proven business model and their unique way of mobilizing capital and take it into new countries, as opposed to having individual companies trying to go into those new markets and doing it on a much smaller base. And those companies like Solar City will be attractive for, among others, pension fund investors. So.
Yeah, I think that's a very important distinction between development and deployment. The focus on deployment, you know, 20 years ago we didn't have the technologies. Today we have technologies, a lot of technologies, and we have to deploy them at scale. But this leads me to a follow-on question. We had a really good discussion also with Samy about the difference not only between development and deployment, but also between mitigation and adaptation. You know, what do we see there that changes also in the discussion in the large pension funds? And this is maybe then after this I would like to open it up to the crowd, that you can ask also our panelists, but maybe if you can expand on this new trend that you see.
Yeah, I think if we talk about finance, you always talk about risk reward. And if we look at mitigation, it's opportunities. Opportunities to get into solar, opportunities to change the way we do business. And adaptation has been the poor brother or the poor sister who doesn't have a positioning. And so everyone, even the name adaptation, I didn't know what that meant until I was 12 months into my job. But adaptation is really risk, and it's risk mitigation. So mitigation is about business opportunities. Adaptation is about managing operational risks for every company. If today you tell me that Abu Dhabi or Dubai are going to be underwater in 20 years, I'm indifferent. The CFOs of most companies are indifferent, other than it may alter their shopping vacation. The reality is that it's the largest re-export center for Toyota. It's the largest re-export center for Sony. So if we don't take risk mitigation measures, it means your Sony television is going to be more expensive. It means Sony costs are going to go up. And right now, Standard & Poor's and Moody's have not built this risk into risk rating models. And so cost of funding for companies that are highly exposed to climate change is being subsidized. It's being mispriced. And the issue at stake is, I've been on the job now for close to 2 years. I've had the pleasure of meeting, of seeing in conferences, head of states, ministers of environment, businessmen, but not one central bank governor, not one managing director of one of the rating agencies. And it's conspicuously obvious that they're missing from the party. Is it because we haven't invited them, or is it because they don't want to show up to the party? And it's time that we demand that they show up to the party, because this isn't mortgage-backed securities where if something blows up and they miss it, it's oops, let's get it right next time. This is really, if you're mispricing assets, here's what happens, and we're in the lower mainland. You've got rated companies that are building in floodlands. And if you build a Costco in floodlands, that means that people will build their houses around that Costco. And that means that the city's going to build a bridge towards there. And all of this is high-risk propositions, loss-making propositions when you look at it over a 15-year cycle. But if you penalize the companies that build on these lowlands through their cost of fundings and risk ratings, then they will build their business infrastructure in such a way that adapts and lowers that risk. The housing units will be built in less exposed areas, and that bridge, public infrastructure money, will be adapted. So we need to reposition adaptation as operational risk mitigation, and collectively we need to demand that, it's not enough. They're doing things on the margin and we're told it's going to come out in 2-3 years' time, but we need to demand the presence of central bank governors and of risk rating agencies today, if this truly is an urgent issue. If it's not, we can wait 5 years.
You have it?
Yeah, I just want to point out that one of the 5 managing directors of P80 Group is Dr. Alan Jones, who's a well-known climate scientist in East Anglia University, and was one of the original advisors to Prince Charles, and still is. Anyway, he has done a series of very interesting papers and advice to actuaries and for the large insurance companies. And so at the highest level of those companies, I know directly that they are at least receiving the news, because I know the news that he's delivering. It's very much that, these risks of climate change are real, and that the adaptation is going to be necessary to meet those risks. So I think that the pressure is building, and I would think that soon enough it'll be a little bit like the coal history with the investment banks. I think we heard another panel that the first people to, I guess it was actually Amory Lovins, was saying that the first folks to notice that somebody, maybe an industry, may be going to be toast in the future because it's got the wrong business model, are the investment banks and the financial institutions. They don't want to wait until the toast goes through the toaster. They want to know now and de-risk now. So.
Very good. Thanks a lot. So with this, I would like to open for questions from you. Yeah, please.
This is a question for both the bottom up and top down to address the scalability issue. My question is, to what extent is this just about efficiency, transaction efficiency, versus cost of funds? And does there have to be a realignment on the cost of funds in order to get the scalability accelerated?
David? Yeah.
So the scalability is how you get to the 100 million and beyond. The cost of funds question is driven by two pieces. It's driven by a top-down. When you're at a pension fund and bank level, they're doing a risk analysis. And the more data points you're bringing to them, and the more transparency there is in that data, the more the risk is understood. So the first capital that people raised for solar, Jigger tells this funny story in his book about he went in and said, well, you should give me money cheaper than you do the coal guys. And they said, great, they laughed, and they charged them 10 points extra because it was the first solar financing. And now that cost of capital has come down as lots of data has come out around the performance and the technology and the weather systems, et cetera. So that's at a top-down level of how cost of funds is affected. And then at a bottom-up approach, it's looking at what is the return expectation of individual investors and how can we make those investments more efficient. So that's what Markus is and the solar platforms, the solar bond platforms, and what we're trying to do at CoPower is make the link between individual investors, people in Nelson, BC, and in Quebec City, Quebec, and looking at their own pension, their own retirement and savings, doing some risk analysis, saying how do I invest in this sector, and giving them an easy entry point. The more inefficiencies in the market we can, so the more direct investing we can do, it means the less brokers you have to pay in the middle, so that's a cost of funds. And that's really one piece of the technology-enabled platform and how that's changing the cost of funds equation.
And maybe just to add to that a little bit, there is a sort of learning process in the market right now. That if you look at parties, how they're essentially adapting to the market, like the operators, the actual sources of capital, how they're deploying their capital, how they're actually originating their projects, that a lot of that is an iterative process. And just to give you an example, that we're very fortunate that we work with 10 governments actually. We work with the Government of Canada on a project that's backed by them called Convergence. And they actually structure private investments in public equity. And that's been a sector that's been very ad hoc. And they put this into a platform where they have a lot of large institutions, Citigroup, Blackstone, yada, yada, working together essentially in an online fashion. And that brings essentially the cost of the deals and the transactions down significantly. And these deals, they're quite significant. I mean, they can go up to the $1 billion mark even. So just thinking about essentially winning a few basis points there by structuring the way that those processes work. Now, some of these we've noticed that as you look at essentially the capital at play, the higher up you go, then the worse the tools that they use get. Because you're doing fewer deals, you have essentially a very complicated set of dependencies, people that are involved in the deals, the roles that they play, who has access to what, who has to sign what before they have access to this and that. It's an incredible mess, to be honest. But if you're doing one...
Good for lawyers.
Yeah, and in these deals, you'll have thousands of lawyers. I mean, literally from having 10 institutions in one deal, and I'm not even kidding. And my point is that take a step back and just essentially look at how these deals are done. Because a lot of these lack the structure, then the cost of doing individual deals, you can't replicate that effort. So in a lot of the work that we do and a lot of the tools that we introduce, we see this very basic notion that if you can deal with 10 institutions on a particular deal with a cost of X, you can increase that, then maybe you can deal with 20 institutions. maybe 25, maybe 30. Some have gone from 50 to 500 or from 10 to 100. So it's a very, very clear benefit that if they can talk to more people, if they can include more people in the actual transactions at the same cost, then there they start to have those types of efficiency gains. But it is a learning process. Coming back to earlier, then it's not the case that it's just efficiency. This also allows them to get into different profiles of deals that they might not have had access to before. Because of their cost structure and changing their models of operation, they can also look at deals that might be, let's say, lower the capital ladder because their cost structure might adapt to them. So it's an interesting question in terms of looking forward that when you have these types of tools introduced, and introduced is one way of saying it, but you could also say forced, because a lot of the institutions, they don't, to be honest, have much of a choice. When we were in Davos a few weeks back, we had 2 clients there at Davos, and it was eye-opening to see a lot of the financial institutions' heads, the CEOs of large banks, talking about how they are all fintech innovators. And that's all great, but I don't know what that means. So from our point of view, it's getting to the stage that the largest institutions on this planet, they're thinking about how does this relate to us? And the conversation they're having is how are we relevant in 5 years or in 10 years? Efficiency is a big part of that, but it's also how essentially they meet the demands that are imposed on them. And that is a big challenge, and I think that's also a big opportunity for all of us to really work together on these types of things and bring these stakeholders together in these deals.
Yeah, I was going to say there's a kind of, there's another trend I think that's out there that is going to intersect with this demand for more vehicles and mechanisms for funding clean tech and climate change related technologies and companies. And that is the increasing role of ESG type investing and environmental social governance goal based investing. And the example of that is there's a large wealth manager for a lot of high net worth individuals and others interested in ESG investing called Veris in New York that we're working with on some initiatives to both improve the rating and analysis and systematize the analysis of scoring companies based on their ESG performance, if you will. And secondly, in deploying capital into related investments, but doing so in a way that is return is an adequate return for them, but not at high risk. So de-risking that investment set at the same time. And the fact is that normally these investors tolerate a slightly lower level of return in exchange for the goals being satisfied that they are seeking to meet.
Thanks a lot. So I would like to open the floor to another question. Yeah, please.
Was that me? Oh.
Yeah.
Hello? Sorry. Hi, I just have a question.
Oh, okay.
Sorry, Wealthshare Capital Management. I own an exempt market dealership, work in the private capital markets every day. And one of the things that we see is oftentimes innovation and creativity is somewhat handcuffed a little bit through regulation. Obviously, there's an important role for regulation to play, but sometimes it can be very prohibitive as well. And we're talking about innovative, new, creative ways to finance. I know this answer is going to differ significantly between the pension funds because you look at the world from a totally different perspective from the bottom-up approach and the average investor. But could each of you talk a little bit about some of the changes that you might like to see or would be beneficial to see from a regulatory standpoint, and what some of the positive impacts that could have on getting us all closer to the goals we're trying to achieve?
Do you want to start?
Yes, I think from the discussion of the panelists, it really reminds me about in nature, I do think the green business is so much different from the other business because people are making so hard to reduce the environmental risk. But in terms of economics, the environment is something really like the public good. So nobody wants to pay for it. That's the real situations in the market. So unless we have the government regulation comes in and change the market condition, and especially in the beginning of those new technology innovations, the government subsidy are so much helpful to make people deploy those new technology innovation. So I do believe that there are some promising instruments, financial instrument, but it has to be some kind of a combination of government regulations or subsidy, and once those conditions has to be changed, then the private financial fund can come in. So in order to meet a successful business model, there got to be some kind of nobody worse off, and at least one person better off in the green market.
Yeah, maybe I would also like to ask you, John, you know, like we had a very inspiring talk and keynote by Prime Minister Justin Trudeau as an opening speech, you know, and I feel since some months there's really like a fresh wind going through Canada, I feel. And how do you see that, or what do you expect also from a new government now, for you knowing the market in Canada since many, many years? You know, what does this mean for you or for your work personally, or is this even related to the closing today? By the way, congratulations to that achievement today of this new fund. Is this somehow related?
No, it's not. It was the last government. But the new government's living with it and they're happy with it. I think the biggest change at the moment in Canada is the definition of an accredited investor is changing. And partly because of crowdfunding and the ability of people to finance stuff, you know, over the internet. It hasn't changed entirely, but it's coming down. But government is concerned about, you know, having our basic number across the country changes, but Ontario is $250,000 net worth. I mean, you have to have that kind of money in the bank to be able to be an accredited investor. It doesn't include your house. So that number's got to come down in order to make a lot more people, you know, in the market for real. Because the government's concerned that somebody that's, you know, some elderly person invests $100,000 in a power plant in Afghanistan and they lose it. They're concerned about that. So the definition of accreditation is a serious issue, and it's being addressed. But it would be nice if it would be opened up to a larger group. But it begs the question of then who does the due diligence on the crowdfunding projects.
Maybe I would ask, you know, when I learned, Markus and I met the first time, this was 5 years ago, and at that time, his main problem was that you ran into regulation problems all the time. And you got so knowledgeable about it because you had to build the platforms in the regulations. So now you actually can advise the European Union, the US government, also the Chinese government on how to write regulations that crowd investing will work. So maybe you can share some of your insights and how you see that change, what you personally experienced in the last 5 years regarding to regulations.
Sure. And just as background, I personally started out in what I call the digital finance market back in 2008, 2009. So the very inception of, you know, very topical time, put it that way. On the regulation, the way that we view it, from the background of having worked with 7 national securities regulators, that it is more than anything a catalyst. That when we started out, the regulation didn't exist. I mean, it wasn't that the regulation was inhibitive, it was just that it didn't exist. Like, for example, the definition of accredited investor, and $250,000 here, I mean, that's $1 million in the US. So that's one thing that is being discussed. But a lot of these regulatory frameworks, I mean, we track over 100 in different states, in different provinces, in different countries, and for different assets and different types of funding vehicles, equity, debt. There's a lot going on. But a lot of it, it's not new. I mean, these types of private transactions, which is typically the context, they've been happening for a long time. So you have essentially existing regulatory frameworks that you can use. And we work in a regulated business. I mean, we are a technology company, but out of our clients, nearly every single one of them is regulated. And the ones that aren't, they're exempt funds, for example, so they don't have to be. But that being said, regulation has actually not been an issue recently. The thing that we see is the uncertainty with some of these new regulations. Like, for example, if you're an exempt market dealer or a broker dealer in the US, and then you have these new bills, like for example in the US you have what's called the 506C offering, where you can essentially generally solicit a private transactions online, so you can market it to anyone. But because it's new, then there's a lot of risk aversion. That what does it mean? Where's the line? What is a general solicitation? If I tweet about it, what can I say? Then that type of uncertainty and the lack of clarity and where the line goes, that's still an issue, and the lack of knowledge in general. One of the most successful regulatory approaches to this market that we've seen has been in the UK by the Financial Conduct Authority, the FCA. And it's not because it's innovative, it's not because it's fantastic, it's just because it's really clear. And the benefit that the UK had was being a very practical, and you could argue a smaller country, then they essentially went about regulating it in a way that they let the market play out for the year and a half or 2 years, giving people and companies special authorization, and essentially just seeing what happens. And they found that essentially a lot of the companies, the actual operators that were facilitating these transactions, they were going beyond what the FCA would have required. So when they actually wrote the rules, they were doing so by essentially taking the market's feedback into account. Now, that is the UK, where you have one securities commission essentially overseeing the market. Take the case of the US, for example, where you have state level regulation, you have federal regulation, you have different regulatory bodies. It becomes a lot more complicated. So we view it as a catalyst that essentially the discussion around who can invest in what type of transaction, who is allowed, do you have to be an accredited investor or not, we view it as a catalyst in a way that it's bringing the conversation forward. Because there's some very backwards ways that you could think about this going. Like, for example, if in the US, you as a non-accredited investor, if you can't invest in private transactions, do you have to come to Canada to invest in private transactions? Do you have to go to Mexico? So both of which countries have different regulations already in effect or in process. So it becomes a very, very interesting experience. But just from our or my personal experience working with these securities regulators, then they're all bright people. I mean, they're very smart, forward thinking. I think the challenge that they often face, it's not about how the future looks. I mean, they see the same future that we see, that the internet and access to information is changing the way that people get involved in projects. If you want to support solar technology, then why couldn't you invest in it if you wanted to? But I think it's the steps. What type of step you take today, what type of step you take tomorrow, and how you actually get the buy-in and the actual information out there. Those are typically tricky. But the fact that the conversation's out there and people are actually pushing them in terms of bringing these new regulations to the market, that's very encouraging. Like in the US, we'll have this Title III of the Jobs Act, so the actual non-accredited crowdfunding coming into play about 2 months now. And what effects that will have, we don't know. But at the same time, we do know that it's going to cause a lot of discussion, and it's going to force people to essentially figure out how that discussion translates into action.
Thank you. Then I would like to give to the gentleman there. Oh, maybe first, sorry, within the white, sorry. Sorry.
Hi, this is pretty cool, actually. This is for Samy. You mentioned about the party having the bankers as well as the rating agencies. Can you comment, and as well as the rest of the group, comment about the insurance and the reinsurance sector as well? Because I think they need to be at the party.
It's a very important question. The reinsurance, the insurance companies actually are also part of the insurance companies, are part of the P80 group. So this is so they're involved. And I personally feel, that when you talk about risk, the risk business, that's the business of insurance companies. And we work with one company in Arkansas also that they actually help to secure, to help to to cover the risk, in a solar project, for example, or in an energy efficiency project, where you don't know exactly, if a storm comes in, your energy efficiency gains might be different, but you don't know if the storm is coming in and will affect your results. So actually, this insurance company covers this risk. So for a pension fund, even if a storm is coming or not, they know this does not affect their returns. So we see insurance companies on different levels involved in that. But maybe, Roger, you can expand on what you see from the P80 group, what the inputs are from the large insurance companies.
Well, we haven't probably spent as much time with the insurance industry as we'd like, but I think the products are continuing to be developed, to meet the need. And of course, in terms of technologies, there are these certification bodies that have increasingly become sophisticated and active in certifying technologies and technology efficacy. So I think that's an important part of it. But I don't know, Samy, did you get a chance to?
No. Look, I think insurance companies are like pension funds or like anyone else who has funds to invest. We need to understand them and what their daily needs are. So let's split the insurance company into two. You have the investment arm of the insurance company, and you have the insurance arm, the de-risking arm. If we're looking at the investment arm of an insurance company, they're not too dissimilar. Their needs are not too dissimilar from pension funds. So everything we said about pension funds applies to them with some degree of modifications. If we're talking about the de-risking arm, the actuarial business, it's one that needs to make money. And so even if they ramp up, there are areas that they're not going to touch. And so when you look at adaptation, when you look at rising sea levels, when you look at, I was giving the example of Dubai being underwater and what does that mean? There's no insurance in the world that's going to take that, because there's no one that's going to reinsure that and and help them square that position. And that's why, yes, there is a role for them to play, but the focus has been on them. How do we de-risk? Well, we de-risk by going to the insurers instead of saying, how do we de-risk? Well, we de-risk by giving a business case to corporates to de-risk for themselves. So if I'm the CFO of a corporation or the CEO of a corporation, and today you tell me, hey, listen, in 20 years' time, if you're on the Fraser Delta, in 10 years' time, you have a 4 sigma probability of being hit and your warehouse is being underwater, New Orleans. My take on it is, okay, let me get through this quarter and I'll talk to you at the end of this year. But if you come back to me and I'm having that conversation with Fitch and they say, boss, if you don't do something about it, we're going to have to downgrade you or give you a negative outlook, and that's going to mean an extra 50 basis points to your cost of funds, then I'm going to address it immediately. And that's where the immediate solution lies. And that's traditionally how risk has been handled. And then the insurance companies come in and take what is mainstreamable, what is tradable. So I think a lot of attention has been given to insurance, to the detriment of the role that banks and those that regulate banks and rating agencies need to play. So it'd be beneficial for us to have that lens. And that problem is only going to grow bigger. They say that a dollar not spent on adaptation today or operational risk mitigation today is you'll need $2 or $3 down the road. The reality is that you're going to need more, because right now we're all punch drunk with liquidity. And I mean punch drunk. And, the party's ending. I hate to, those of us that are children of the 80s, remember our dads paying 18, 17% mortgage rates. So this is not science fiction. And when Yellen continually says quarter after quarter, I'm going to increase rates, well, we know what's coming down the pipeline. And so today, when interest rates are near zero or negative, if you're not capturing the attention of a CFO today and capturing the attention of banks today when it's near cost-free for them to do it, Yes, there's leveraging, yes, but near cost-free. You're definitely not going to get it if the guy's got to pay 8%, 9%, 12% to borrow money to risk mitigate. Then forget about come to me, give me till December 31st, see me at the end of closing. It'll be see me in 3 years' time, and let's see if the company is actually surviving. Well, we need to do it now while the cost of funds allow us to do it.
But
Thank you. Yeah.
I think there is a role, and I'd be interested, Samy, if you have a comment on this, and it relates to the regulatory environment, was the role of carbon tax and carbon, capture, or cap and trade in having a predictable and perhaps in that sense a liquid market for the beneficial adaptation and so on. How do you view that as a financial matter?
Look, I have a particular view on carbon trade, and that is every currency needs to have fiat. And if you try and create a currency, which it is a quasi-currency without fiat, you're doomed to having market failures. And the experience we've had now, China's trying something out, and let's see what happens with them, is Markus said something really, at the base of finance. Regulatory certainty. I wake up tomorrow morning, I know that my Canadian dollar, my US dollar, is going to be backed by the central bank. And I know that, with a heads up, even if quantitative easing is going to happen, that my central banker's telling me, hey, listen, I'm quadrupling the supply out there, and I'm going to be doing it over the next 10 years, so take measures, whatever your measures are. The problem with carbon credits is today the government implements them, tomorrow, well, not really, after tomorrow, this is what we're going to take, the day after, this is what we're going to calculate. Financiers hate regulatory uncertainty. So if you're going to do it, treat it as a fiat, treat it with heavy backing and regulatory rigor, or don't do it at all. Right. Because then you're just burning cash every time you're
creating volatile markets, in effect, and uncertainty.
Without trust.
Right.
That's a very good point. Maybe the last question, and then we will wrap up in with a personal statement then. Thank you.
This question is more for the folks on the stage that are wealth managers, fund managers. And what I'm interested to interested to know is, with regards to your existing portfolios in light of COP21, what are some of the things that you are considering in order to decarbonize your portfolio? Is there an effort to try and do comparative analysis on, yes, this is something new, this will probably last for the next 50 to 70 years. This is something existing in my portfolio that might not last another 10 to 15 years down the line. Is that a consideration? If yes, if you could shed some light on how that's being done at this point.
Sure. I can talk about it a little bit from the perspective we've seen with the online lending platform. Look, there's individual portfolios and then large pension fund portfolios. So I'll talk more from the individual perspective. And the sound was a little bit off, so I'm not sure if I got all of your question. The last couple of days, you've seen Carbon Tracker, you've seen a bunch of other people talk about trends in the market where individuals are coming and saying, either from purely a financial risk perspective, some people are coming from a moral and ethical perspective, and that's fine as well, saying we want to invest in things that are green. And right now we don't know what's in our portfolio at a personal level. It's very hard to understand, if you own a series of mutual funds, what are actually the companies you're in. And people, once they get some tools, they find out, oh, I'm actually invested in a couple private prisons, I'm actually invested in a bunch of oil and gas companies, and I'm invested in some firearm manufacturers that don't align with my values. So how do you first provide tools to make it easy for people like you to do 2 clicks and understand what is actually your investment portfolio? And then you can bring your financial risk analysis plus your values alignment to that. And then you can reallocate into either ESG screened private equity, public equity funds. You can go to Kensington Capital and say, I like the funds that you're running, and you can come to CoPower and say, oh, I like the wind farm that's backed by the utility company here. This looks like a solid investment for me. I want to be reinvesting into clean energy that's in my communities and supported my communities. So that's the experience that we've seen. For a large segment of the population, it's not easy to invest in green and invest in value-aligned ways. And so what we're trying to do with technology-enabled lending, and same that Crowd Valley is supporting other solar bond platforms, is make it easier for people to be investing in those ways. That's different at a pension fund level, but that's what we're seeing at the individuals.
Yeah, John, what's your take on that?
Yeah, I invest in 24/7 power plants, which sort of limits me, but I like what we're investing in. Heat recovery off compressor stations, big problem. We're giving all this hot air into the atmosphere. We know how to capture it now. We capture it, run it through a heat exchanger, and drive a turbine. I like geothermal because we're taking hot water from 2 miles down, bringing it up, running it through a heat exchanger, driving a turbine, and sending the water back down to be reheated. Simple. Energy storage, I like it a lot. When we designed a lot of our solar programs, we did not predict that solar and wind would make our power systems unstable. BC here has one of the most stable power systems in the world, because they don't have coal and nuclear and all those other things. But now we've got solar and wind, and every time a cloud goes over a solar panel, the power goes out. Not really, but I'm just using that. So I like energy storage, and I like district heating. We have 80 district heating companies in North America. They all need to be expanded. They need cash, and they're green for the most part. And they do good things, heating and cooling buildings. And it's geothermal, whatever. So I just focus our portfolio. I own 10 power plants now. We're buying more, and I just make them 24/7. I played a lot of Monopoly as a kid, and I realized if you own the utilities and the boardwalk, you won the game. I haven't changed.
And then the hyperloops are the new railway monopolies, right?
Right.
I really like that, John, and this is also then coming to the closing. I would love to expand on these discussions also afterwards, and please engage with us, all of them. But I like how you described it, John. It's a very big topic, but also we have to approach it with openness, with fresh eyes, also with some humor, to really make things work. For me personally, it's a huge achievement. When I think back 10 years ago when we started in this work about this finance innovation for scalable global technology deployment, because at the time our idea was, when we talk about energy efficiency and resource efficiency, we also need to talk about finance efficiency and business model efficiency. 10 years ago, this was a message unheard, and people looked at you like, I don't really know what he's talking about. Today, this panel has proven we made huge progress on this. Cost of funds, finance efficiency is a tremendous driver of what we try to achieve. And with this, I would like to give an outlook from you. Hopefully that we will meet in the next months, but also come back then in Globe 2018. And as a closing remarks, maybe starting with you, John, what would be your wish with regards to finance innovation driving global technology deployment that will happen, that we can then talk about in 2 years when you're coming back here to Vancouver?
Very simple. I think you start small and aim big and go for it. You have to take risks. So, sorry. I believe you have to start small and aim big, and try to go, don't be afraid to take risks, because that's what life is.
Thank you. Li Chi.
Yes, I still do think most new green technologies still not so promising in the market. So we still have the investment risk. So from what I observed, the investors are not so supporting green business. Then if once we can reduce the investment risk of a green business, then it will be easier for the society to become green. So I would say that there are two major key drivers will be coming and to be observed. And one is the government regulation, because we all know that the COP21 last year have reached some consensus. And then I think right now every country has some domestic policy in order to achieve their goal of environment. So I do think once the environmental regulation or domestic regulations reduce the investment risk of investment in green, then we will come to the financial method or innovations will come to the crucial one key drivers. Thank you.
Roger, what would be your wish for the next 2 years?
Well, I think we can assume from what we've heard at this conference that there's a real momentum that's built towards addressing the decarbonization of the economy, and that the urgency of it is getting increasingly obvious. It's not a very debatable matter anymore. So I think that with that consensus hopefully coming into place, notwithstanding the U.S. presidential elections, by the way, the idea, what I'd like to see is that there's been a very clear, definitive, locked into place policy that isn't going to change from government to government, that encourages investment in the sector, and perhaps that's a fiat-based approach that Samy mentioned. And secondly, that the innovation forces that are unleashed in the economy when they face a clear enough need and a demand will be that much faster to come to the fore and start to really provide innovative financing vehicles for us.
I think it's important to not lose sight of our goal that I talked about right at the beginning, which is $10 trillion, right? We need to understand that that's the end goal of investing that amount into green infrastructure. I'm very excited about the role that new financing mechanisms like online lending and like what we're doing at CoPower can do to make it easier for more investors to be participating in that. I think Prime Minister Trudeau's message was, I'm here, but it's you. I think there's a tremendous energy in Canada now about people that want to be pushing green policies and also having their portfolios aligning with their values. So the more players get me helping simplify those investments, the better. And hopefully we're having a giant after party at Globe 2018 that we are inviting all of you to.
Okay.
From my point of view, one of the things that I'm looking forward to, especially with finance technology, is it actually become very practical, very actionable. So what I mean by that is right now we're working with online lending, business debt, solar bonds, all sorts of different things, but it's such a fraction of people that actually know about those or understand what they are or actually participate. I mean, the way that we look at the future is that you go into your kitchen and you look at your portfolio on your fridge. That's the type of technology that we like. That technology is very much part of your life. Like, for example, if you're working in or if you're investing in a mutual fund, I mean, most people don't know what's actually in it, to be honest. I mean, I have an economics master's degree and I look at the structure and I might not understand.
Sorry to interrupt, but we have just maybe 10 seconds, the wish.
But I look for that essentially people actually can look at their balances, their portfolios and everything in very, very practical terms in their life. That's going to be very important.
Thank you. Samy?
Global balance sheet is $250 trillion. Half of that sits with banks. The other half goes through banks. The party cannot take place unless we force them to the table. Central bankers like to say we're industry neutral. That's not true. The U.S. chose to pump money through mortgages, so residential real estate. Europe, Draghi's doing it through SMEs. You do it through Cleantech. You create discount windows for Cleantech. You create capital breaks for Cleantech debt. That's what you do. You need to invite the central banks to take a hard look at what their action plan is to mobilize the mainstream balance sheet.
Thank you so much. And with this, I would like to close the panel and thank you. And please join me to give an applause to the tremendous panel. Thank you.